with discussing internal controls. So even though there was a little bit of goofiness in understanding the Sarbanes-Oxley Act, it can be dry, but we'll talk about why we have internal controls, the need for internal controls, and where we've come from since the Sarbanes-Oxley Act was passed 15 years ago. Incorrect financial statements. Why would we have incorrect financial statements? Well, some errors are truly accidental. Accidental errors in recording transactions or applying accounting principles. And then, and errors are accidental. They're not technically intentional. Fraud is a concept where someone intentionally deceives another. So there is an intent of wanting someone to believe something that's not true. A person intentionally deceives another for personal gain or to damage that person. Now, occupational fraud's the use of one's occupation for personal enrichment due to deliberate misuse or misapplication of employers' resources. So what has happened in our society, I think since the beginning of time, but it's been exposed greater than ever back in the late 1990s, early 2000, is there were many people that had a great incentive to commit fraud. And we'll talk about some different scenarios. You saw a little bit on the slide, but we'll talk about it. I love this fraud triangle because what's interesting to me about it is you need all three aspects in order for fraud to be committed. So the triangle has three elements to it. There's got to be an opportunity, which means the situation that is present that allows fraud to occur. There's got to be some type of motivation behind it. Somehow someone feels the need to commit fraud, such as the need for money. Oftentimes motivation can take the place in a gambling problem or in the place of financial issues. Then, this is key, there's rationalization. Some type of justification inside the mind of the fraudster that deceptive act, to justify the deceptive act by the one committing the fraud. The interesting thing with the fraud triangle is if one of those elements is not there, you cannot have the opportunity to commit fraud. So we're going to talk about how this plays out in a business setting. Now, you know, there have been some even churches, and churches can be the worst. There have been some churches that have the parishioners or the members steal money. How could that happen? Well, somehow there's an opportunity, which means one person is handling the cash. I know at this church I'm in, they have 3 people that come together to handle the cash. So 3 people, the ushers go and lock it up until the next morning. 3 people come together, and for whatever reason, they all 3 need a certain code. Maybe they each, I don't know how it works. They all 3 count the money. Could there still be fraud? There could be, but there would have to be collusion among those 3 people, which would make it a little harder. So there's got to be an opportunity. There's got to be motivation. There's a need for money or some type of need. Oftentimes it's gambling debt. Sometimes it's a medical issue. You know, there's a reason for fraud, and then that person has to rationalize somehow. But look at all that I've done for this church, or in a job setting. Well, I know I'm making only 20 bucks an hour and Joe's making 30, and that's not fair because I'm working harder. Do you understand what I'm trying to say? That rationalization that makes it in their mind, their behavior justifiable. Because of mistakes and fraud, we have internal controls in place to help eliminate the opportunity element of fraud. Now, you can't control someone's needs and someone's rationality, but what we can do is to try to control that opportunity for fraud to happen. Internal controls represent plans to safeguard a company's assets and to improve the accuracy and reliability of accounting information. Have any of you guys worked somewhere where you can kind of think of a type of internal control that took place in the company? Anybody? I know my daughter, when she worked at a shoe store, forget the name of the store, but it's like a fitness shoe store in the Mall of America. There was only one person that was allowed in the storage room, you know, where the shoes were, and there were cameras in there. So what that did, just the fact that only one person was allowed in there, it eliminated shoes walking off. So none of you have had experiences of safeguards in place for watching out for what? Tell me.
Like working in like bars, only one person will get alcohol or booze from like the storage area, and it's locked up constantly.
So, and why do they do that?
So that people won't steal alcohol.
People won't steal alcohol because employees can be the biggest source of theft in a company. You think it's the customers, but it's not. It's the employees. So, especially when we're dealing with accounting, there have to be so many safeguards in place just because that opportunity is so prevalent within accounting. The reason, okay, so let me back up and say internal controls have always been important. But what's happened is there were so many accounting scandals that occurred in the late 1990s, 2000, one of the biggest with a company called Enron. And it was just gross, egregious behavior of falsifying the books for the head management to gain millions and millions of dollars. There was another one, there were many all at once. So legislation was passed called the Sarbanes-Oxley Act of 2002. And basically what was discussed is we know the managers that run a company are entrusted with the resources of the company, and they act as the caretakers of those resources. Since management has not held an ethical standard in protecting those resources due to people getting money off of increased share prices, increased financial statement positive results, increased share prices, which increase stock bonuses, okay? So because of wrongdoing on behalf of management, now what's happening is that what's passed by Congress is that there are guidelines that public companies have to adhere to regarding internal control procedures and also regarding auditor-client relations. Usually there are external auditors that can come into a company and provide an opinion regarding their financial statements. Well, there's been a collusion among the auditing companies and the company that they're auditing. They are not independent. So as a result of this bad behavior, Congress now basically requires all kinds of different information, but the big thing they require are internal controls. The company's management must document, which is what the Goofy article was about, you know, with the head guy and the socks chick. It must document and assess the effectiveness of all internal control processes that could affect financial reporting, and that company auditors express an opinion on whether management's assessment of the effectiveness of internal controls is fairly stated. So there's all kinds of guidelines with SOX, but the key we're focusing on is internal controls is paramount to companies having accurate financial records. The accounting scandals of the early 2000s prompted the Sarbanes-Oxley Act and basically is now mandating the guidelines for internal controls. Which of the following statements is not true of the Sarbanes-Oxley Act? A, all companies in the U.S. fall under its provisions. B, it helped establish guidelines for internal controls, which is true. It helped establish corporate executive accountability, which is true. It helped establish guidelines for auditor-client relationships, which is true. Do you remember me saying SOX was required for all public companies? So private companies are not responsible. It's companies who are required to file financial statements with the SEC are required to adhere to Sarbanes-Oxley. So let's talk about internal controls. As you saw in one of those boring slides, but they're helpful to hear other people speak besides me, there are different ways of collecting information in a manner, seeing that people are carrying out their duties as they're supposed to. A control environment is the environment that sets the overall tone of how we are going to respect internal controls. The policies in place, management adhering to those policies, certain responsibilities in place per employee. Then, so that control environment is the base of how a company respects internal controls. Have any of you guys worked at a place where even the management jokes about internal controls, or they don't really care, they're just slough about it, where there are other places where internal controls are really important and it's respected? Next, a risk assessment is what really looks at the internal and external factors that could prevent a company's objectives from being achieved. So, for example, risk assessment. When we're dealing with shoes at, gosh, I can't think of the name of that company, but anyway, you look at where is their potential risk and what are we going to do to protect our risk. Think of a casino. Where's their risk? Everywhere. But they're dealing with a ton of cash. So they need to look at the assessment of where is their risk the greatest and provide controls in place to protect that. Hence the need for cameras, for those who are cashiers to be responsible for what they're collecting and making sure they're following the right guidelines. From there, we've got control activities, policies in place that basically include who authorizes things, who reconciles things, and various separations of duties. So what that means is maybe the person who goes and deposits the checks at the bank is not the person who records the bank the bank register each month. You want a separation of duties so you can find someone to catch any errors. And then lastly, as you heard on the slide, control activities are worthless if you don't monitor them to make sure that they are in fact working as they should. So anytime there's a financial statement, records where there's an opinion presented by an auditor, it always states the company's internal controls, and the auditor is required to assess them and to document them. So here's an idea of just a movie theater. Preventative controls, the employee selling the tickets should not also account for cash at the theater. Concession supplies should be kept in a locked room with access only to authorized personnel. Only theater management should be authorized to make purchases over a certain amount. Employees should be made fully aware of the company's internal control procedures, ethical responsibilities, and channels for reporting any activities that may be irregular. And the theater should maintain and systematically check the firewall settings to prevent unauthorized access to accounts and credit card numbers. Boy, in this day and age, did you hear that even Experian, one of the credit bureaus, just got hacked?
134 million people's information or something.
I mean, we're all a part. If you've even applied for any loan, you're a part of it. Yes, Montana.
Oh, no, I was saying that I have, because I work at a bank and they sent us out an email and saying, like, about 2 million, I think, or so people, or maybe even more. I remember there's something like 2 but have been affected. So they sent you like a thing where you could go and check and see if your name has been compromised.
It's crazy. It's crazy. Then management should determine whether the amount of physical assets of the company agree with the accounting records. So generally speaking with companies, things are tagged and logged. So that way we know what's an employee asset, a company asset, what is not a company asset. So the CEO and the CFO are required to personally sign off on the financial statements showing that there is an adequacy of internal controls. So what's happened is those in control of the company, or those that are managing the company, are supposed to personally certify that things are in place. Has that stopped abuse? No. It never will. I think SOX tried to put something good in place because they needed to, but if you're going to steal, you're going to steal. I mean, look at all that's happened since 2002. I mean, where do we even begin? Just locally. Ponzi schemes, Denny Hecker, you know. Who else? Who's the other guy who gave a lot to different charities, but yet he was still a scammer? What am I thinking of? Finger Hut. God, I've got I'm stuck with. Anyway, yes.
Do you think the people, so like how there's always someone higher that needs to check someone's work, do you think it's easier for the people at the top?
Absolutely.
Because they can just
slide
it on past?
Absolutely.
So who's checking their work?
Exactly. That's why, well, auditors do. But that's kind of the little joke. He was the head guy, and the auditor was coming to try to say to the head guy, hey, I want to see your proof. And he's trying to shun her off, like, get out of here. Because that's the reality. The top has a much easier method to shirk the responsibilities because they can break some of those internal controls that are in place because they're at the top. Whereas the lower you go, sometimes the harder it is if those internal controls are in place. Yes?
No, the Sarbanes-Oxley, it's mainly for like more corporate and bigger companies.
Yes.
Because they don't affect like...
It's for public
local
companies.
Right. Well, like Rainbow, that's a public company.
Yeah.
Like Rainbow Groceries.
Yeah, it would affect any company that is publicly traded on a stock exchange is responsible to adhere to SOX. It's caused a lot more cost and expense, but with the intent being it would help reduce fraud. Maybe it has reduced. The penalties are harsher.
Well, I mean, even the guys from Enron were in jail for 10, 15 years, and they made $7, $8 million. You know what I mean?
No, 60 million.
Yeah.
One made 60 million as he was leaving, cashing in his stock. I'm going to post.
That got seized, though.
It did get seized. You're right, but they still lived a great life, and all their employees lost everything,
because of that.
Which is sick. And as a result of Sarbanes-Oxley, now you can't require employees to just invest in company stock. They've made a lot of changes because of that. If a company places cash receipts from the day in a safe or bank deposit box, this could be an example of A, separation of duties, B, physical control, C, reconciliation, or D, performance review. Awesome, guys. Let's look at E43. Okay? E43, for those of you that have printed it out. Who hasn't printed it out? I have 3. You guys can grab them. Here's. Sorry, guys. I only printed 3. I shouldn't have printed any. So E43, the components of, here, let me see what we need to do. Thank you. So for each scenario, determine which control activity is violated. Control activities include separation of duties, physical controls, proper authorization, employee management, reconciliation, and performance reviews. If no control activity is violated, state none. So the components of internal control are built on the foundation of the ethical tone set by top management.
Are we doing 4-3 or 4-4? Because you just read the required for 4-4.
You read the required for 4. Yeah, you did.
Because it's just telling us
I'm
if
so
it's true or false.
Yes, I'm sorry. 4-3, I did read the wrong thing. State whether they're true or false. So I'm sorry about that. The components of internal controls are built on the foundation of the ethical tone at the top. Yes. Who wants to take 2?
Once every 3 months, managers need to review operations to ensure that the control procedures work effectively. True?
Well, it's got to happen
Or more often than
more
that?
often than every
Okay.
3 months, okay? Number 3, collusion refers to an act of a single individual circumventing internal control procedures. We didn't go over this, but I used that word where people come together and collude. So collusion involves more than one person.
I
Yes.
just had a question about number 2.
Yes.
The date, would we say like what the time frame is? Like, is it every week?
It depends on the situation. So, generally once every 3 months is just not going to be enough
Right.
to confirm. You could have been, can I get you something to drink?
Sorry. I just got a drink up there, but.
I have a Diet Coke in my refrigerator if you'd like one. Are you okay?
Yeah. I think so.
Would you drink a Diet Coke?
Just
Sure,
drink.
I'll drink that.
Next one, number 4. Detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. Fraud committed at top-level employees is more difficult to detect because those employees are more often have the ability to override internal control features. Yes. A good example of separation of duties would be having one person collect cash from customers and account for it while having another person order inventory and maintain control over it. No, because
You want to order it and control it.
you don't want to order it and control it. You don't want to have one person collect cash and account for it. You want them to be separate. The problem with small companies is you can't always do that because there's not enough people. Number 7, employee tips historically have been the most common means of detecting employee fraud. It is true. Detective controls include reconciling the physical assets of a company with the accounting records and comparing actual performance of individuals or processes against their expected performance. True. Effective internal controls and ethical employees ensure a company's success. No, there's a lot more that ensures a company's success than that, right? So basically, the auditors need to express an opinion on the internal controls that are the responsibility of management. Now, there are limits on internal controls. They're not going to turn a bad employee into a good one, are they? If you're a bad employee, you're going to be a bad employee.
Find a bad.
What?
It can find you a bad.
It can find you a bad employee. Exactly. That's the good thing. Internal control systems are especially susceptible to collusion, two or more people acting together. Why is that, guys? Why is collusion sometimes a challenge to uncover?
Because they each can have the same story.
They can have the same story, and maybe different employees have different roles. And then they can collude together, come together to cause fraud. Top-level employees who can override internal control procedures have opportunity greater to commit fraud. And guys, effective internal controls and ethical employees aren't going to alone ensure success. Just doesn't happen that way. Everyone in the company has an impact on the operations and effectiveness of internal control. But who must ultimately take the financial responsibility or the final responsibility? The executives ultimately are responsible for internal controls. Now we're going to look at 4.4. A manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. Which of these activities is violated? Separation of duties, physical controls, proper authorization, employee management. I'm sorry? Oh, you have it already shown? I'm sorry. I don't have the answers. You do. So, why compares total sales in those years of previous but does not compare the cost of production? Performance reviews would be the right answer. So that employees can have easy access to office supplies, a company keeps supplies in unlocked cabinets and in multiple locations. What's wrong with that? Physical controls. At the end of each day, a single employee collects all cash received from customers, records the totals. Separation of duties is highly lacking. At the end of the year, only the company compares its cash records to the bank's records. Reconciliations is missing. We should be doing that monthly. A company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal controls. What would that be? That's a good thing, isn't it?
None.
That's a good thing for companies to be able to have the ability to whistleblow. All employees have the authority to refund a customer's money.
Proper
Authorization, yes. So guys, we are now going to talk about one of the most highly potentially disappearing asset in a company, cash. We're going to talk about what cash is. We'll talk about cash and what we call cash equivalents. So components of total of cash would be coins, checks, savings accounts, checking accounts, credit card sales, debit card sales, and cash equivalents. Which of the following would not be considered a cash equivalent? Credit card sales for the day, debit card sales for the day, money orders, or certificate of deposit that matures 1 year from now? D. Because that is, you don't have access to it right away. So basically, they're generally defined as investments that mature within 3 months, where a CD is over a year. So we're going to talk about controls over cash receipts and cash disbursements. Controls over cash receipts. A smart thing to do is to have a separate employee open mail and then list the checks that are coming in. I know with some of the clients I work with, they have their checks go straight to the bank. So they don't even open the mail. They go straight into the bank, which just eliminates anyone from opening checks. Each day, a different employee should deposit cash and checks into the company's bank account. As soon as possible, a separate employee should record cash receipts in the accounting records and accept credit cards or debit cards to limit the amount of cash handled. So it's smart to find ways to have other paper trails apart from pure cash. Controls over cash disbursements. Disbursements should be made by check, debit card, or credit card. Authorize all expenditures. The one who authorizes it shouldn't be the one who prepares the check. Checks should be serially numbered and should require 2 signatures for large amounts. Periodically agree debit and credit card statements to the receipts. Set maximum purchase limits and separate cash disbursements from cash receipt duties. Now, what is so interesting is the stories you can find online, real stories. You know, they always say truth is stranger than fiction. The real stories you can find online of the various people that have been exposed for doing wrongdoing or had wrongdoing. So we are now going to spend a lot of this chapter talking about reconciling a bank statement. The bank balance of cash may be different from the bank balance in a company's records. So why would what's shown in the bank statement be different than what's shown on the company's records? Mainly due to timing and potentially errors. So what we do is we provide a bank reconciliation where we're going to match the bank balance with the balance of cash in the company's own records. So things may occur for timing purposes where we wrote a check on the company's records but it did not hit the bank yet. Or a deposit may have occurred on the company's records that didn't hit the bank yet. Or there may be bank fees that were taken off of the bank balance, but we don't have record of yet. So as you see various bank statements, in this example, the balance per the bank statement is $4,100. See, you see way down here, March 31st, the balance is $4,100. I don't know why that's so goofy. But per the company's records, the balance, oh, this is weird, is $2,880. So the first thing we want to do is reconcile the bank's cash balance. Cash transactions that could be recorded by the company but are not yet recorded by the bank. So that may be deposits outstanding, which are cash receipts of the company that haven't been added to the bank's record of the company's balance, or checks outstanding. Checks the company has written that have not been subtracted from the bank's record of the company's balance. So then from there we're going to compare receipts and disbursements, cash receipts of the company, cash receipts known by the bank. So if you look at the cash receipts of the company, we've got the $3,600 shown by the bank, the $1,980 shown by the bank. But look, we've got one cash receipt of the company not shown by the bank, and then we have two cash receipts of the bank not listed in the company's records. So that $2,200 that is shown as a cash receipt of the company but's not shown by the bank is an outstanding deposit. That's not in the bank balance. Also, we've got checks written by the company that are shown in the bank, and then there are boy, this is so screwed up. I'm sorry, the numbers are off. Checks written by the company, the 2100, check 293 is shown here, 293. Check 294, we have recorded as 2600, but look, the bank has it as 2900. Then we have check 296 of 1900 that shows up here, 1900. But we've got a couple checks here that we've written but aren't showing up on the bank's balance. So those are checks outstanding. They're checks that are in our records but that are not yet in the bank's records, right? So to reconcile a bank, to prepare a bank reconciliation, we're going to start with the bank's cash balance. Over here, we have the company's cash balance. Then what we're going to do is we're going to add deposits that are outstanding. In other words, we showed them in the company's balance, but the bank hasn't received them yet, so we have to add those to the bank's balance. Then we also have to take any checks outstanding, which means on the company's records we recorded the checks, but the bank has not received those checks yet. So then we end up with a bank balance per reconciliation here of 4,200. Now our job is to take items that are recorded by the bank but that are not recorded by the company. So items that would be recorded by the bank but not be recorded by the company would include things such as if there have been collections that were made by the bank on the company's behalf, oftentimes notes receivable might go straight to the bank and not through to the company. Or it could be interest earned on the bank balance that we don't have proof of yet or we didn't record on our books. Items that would decrease the company's cash include NSF checks, non-sufficient funds, debit card purchases that haven't been recorded, electronic fund transfers, and bank service fees. So debit card purchases would be something that you just show a credit card but may not have been included or recorded on the company's records yet. And maybe the first time you see it is through the bank. So then what we're going to do is we're going to take the various items, such as the $200 in interest. I see $20 in interest. Ugh. And various checks. I'm sorry, I don't know why this looks so goofy. And potentially fix some errors here. So on the bank's balance, you know, we've corrected things that were on the company's records that haven't hit the bank. Now we need to correct those items that the bank recorded but the company has not yet recorded. So as you see, they received a note. There was interest earned from the note, interest earned on the bank account, a check that we deposited as revenue had insufficient funds, so it came back, which reduces our cash, a debit card for some office equipment, an electronic funds transfer for advertising, service fees, and we recorded a check incorrectly. So the amount we recorded it for versus what it cleared the bank for was off $300. Do you see that ultimately once we prepare a bank reconciliation, then our bank balance per reconciliation will equal our company balance per reconciliation? Do you see that? So the key here is, yes?
So, like, if you have an outstanding deposit for like balancing reasons, you have to add that to the base?
Yes.
Just to make it balanced, because it's going to eventually come
Yes.
in? Okay.
Correct. So here is a key item to pay attention to. Know that the bank's cash balance, per the bank statement, we then will add deposits outstanding and subtract checks outstanding, plus or minus any potential bank errors. Banks do make mistakes. And then the company's cash balance, per the general ledger, we'll have to add notes received by the bank, interest received, minus any NSFs or unrecorded debits or EFTs or bank service fees, plus or minus any company errors. We're all able to make errors. So basically what I want to do right now is I want to take some time and do a problem. Let's see. Exercise 4-4. I'm so sorry. Yes. 4-9. 4-9. Spielberg Company's general ledger shows a checking account balance of $22,970 on July 31st, 2018. The July cash receipts of $1,885 included in the general ledger balance are placed in the night depository at the bank on July 31st and processed by the bank on August 1st. The bank statement dated July 31st shows bank service fees of $55. The bank processes all checks written by the company by July 31st and lists them on the bank statement, except for one check totaling $1,460. The bank statement shows a balance of $22,490 on July 31st. So we're going to prepare a bank reconciliation to calculate the correct ending balance of cash on July 31st. Okay? So the first thing we're going to do is show our book balance of the book balance is $22,970, which would be the company's cash balance. And then the bank balance is $22,490. Now, guys, there is the July cash receipts of $1,885 includes in the general ledger balance, but they're put in the depository on July 31st, which means they did not hit the bank's balance, did they? Correct? So that deposit of $1,885 needs to be adjusted. We need to add those deposits to the bank's balance. We also know that the bank statement showed service fees of $55. Those service fees have not yet been recorded in the company's books. So we need to subtract that from the company's balance. Then it says the bank processes all checks written by the company on July 31st and lists them on the bank statement, except for one check totaling $1,460. So that means it's still outstanding. So we need to subtract that check that is still outstanding in the bank, but that's been recorded on the company's books of $1,460. So do you see once we do that, our bank balance equals our company balance per reconciliation? Yes? No?
So their beginning balances aren't even, but then once you go through all the steps, it should be even at the end.
The beginning balances are not equal, but once we reconcile where each one's missing, there should always equal at the end.
Oh, okay.
They will always be the same because the goal is to see why they're off and to make the necessary corrections to make them equal. Now, to record the necessary entries to adjust the balance for cash, we would only need to record the service fee expense because the others just haven't hit the bank yet. But the only thing that we don't show in our records is the service fee expense for $55, and we need to credit cash. So we record journal entries that affect the company's books because ultimately those are the books that matter to us. So we will then be required to debit service fee expense for $55 and to credit cash for $55.
We recorded because it wasn't in the ledger.
That's correct. We just found out about it from the bank. Okay? Let's do 410. I got 411 up here. Why don't we try 410 too? Okay? Oh, wrong book. And this is page, what page is this, guys? 200? So let's look at 410. On August 31st, 2018, the general ledger of the Dean Acting Academy shows a balance for cash of $7,944. Cash receipts yet to be deposited into the checking account total $3,338. And checks written by the Academy but not yet processed by the bank total $1,425. The company's balance of cash does not reflect a bank service fee of $35 and interest earned on the checking account of $46. These amounts are included in the balance of cash of $6,042 reported by the bank as of the end of August. So basically what I need to do, create first one we'll do is the bank's cash balance. Bank's cash balance. And then over here will be the company's cash balance. So we'll start with the bank's beginning balance per bank statement is how much? $6,042. And the company's per general ledger, okay? Now, what's the next step we're going to do, guys? Are we going to look at the deposits outstanding and the checks outstanding? How much are the deposits outstanding? $33.38. Do we add that to the bank statement or subtract it? Add it. Perfect. Then the checks outstanding, what do we do there? Do we add or subtract? Subtract. Now what do we do for the company?
So we subtract the checks outstanding because we're capped, like that's leaving the bank.
Okay, what the checks outstanding means we've written checks by the company. And so the general ledger shows those checks have been subtracted from our bank balance. But the company has not yet gotten them, or the bank has not yet gotten them. So it's not cleared the bank, which means we're taking the money out.
We have to do interest of our
We have to do interest.
and bank minus bank fees from cash.
So service fees get subtracted. And interest earned, what happens with that? Does it get added or subtracted? Added. So we now have company balance per reconciliation, bank balance per reconciliation. Guys, we balance. Woohoo! Now, we are going to need to prepare some journal entries for those items that have now affected the company's general ledger because we haven't recorded those. So the two items we are going to need to prepare financial transactions for, journal entries, would be the service fees and the interest revenue. So when we show the service fee, we're going to show a service fee expense for how much? $35. We will credit cash for $35 to show record bank service fees. Right? And what is the next thing we're going to need to do? The interest. So what will we debit and what will we credit? Debit cash for 46 bucks and credit for $46. And we'll show, record the interest collected by, record interest collected by the bank. How you guys doing with this? Is it making sense? Yes.
Question about the one we just did where it says record interest collected by the bank. On the handout it says record note and interest.
I know, they're wrong.
Okay.
Because we didn't record a note yet. You know, so that was an error in the solution manual. Do you want to do another one? Does this help? Exercise 411. On October 31st, 2018, Damon Company's general ledger shows a checking account balance of $8,397. So what is the first thing we know we're going to do there? On what side? Company. We're going to show the company's balance per the general ledger, $8,397. The company's cash receipts for the month total $74,320, of which $71,295 has been deposited in the bank. In addition, the company has written checks for $72,467, of which $70,982 has been processed by the bank. So what does that mean, guys? Our deposits are what is missing at the bank? $3,025? I would agree. $3,025. We're subtracting the $74,320 minus the $71,295. Then it says the company has written checks for $72,467, of which $70,982 has been processed by the bank. So what does that mean has not been processed by the bank? $1,485. So, do you see right here, we show the bank's deposits outstanding. We're going to add the $3,025. The checks outstanding, we're going to subtract that $1,485. That's the only place we're at right now, so hang in there with me, okay?
So, because it says the cash, the receipts for the month for that, so the outstanding money hasn't been deposited, is that what we're saying?
Correct. The outstanding deposits haven't gone through the bank yet.
But you, as a company, we deposited in the bank that went through.
As a company, we dropped them off at the drop box or whatever, but they just haven't been recorded by the bank.
Because they've been in such incremental amount,
or it could be like, I might have some checks that came in from clients, I just never got them to the bank yet.
right. But on your books, you recorded them.
I've recorded them, but I just haven't gotten them where they need to go.
Okay.
Does it make sense? Now it says the bank statement reveals an ending balance of $11,727. What are we going to do with that number? We are going to put it over here. Bank's cash balance per bank statement, $11,727, aren't we? Okay? And it includes the following items not yet recorded by Damon. Bank service fees of $150. What do we do with service fees? Subtract them from the company balance. Now this is a new one. Note receivable collected by the bank of $5,000. So it sounds like the bank got it, but we didn't know we received it yet. So we have to add that note receivable to our books of $5,000. And then it says an interest earned on the account balance plus from the note of $320. So that means on that note, we increased our balance $5,000, and we also earned interest of $320. Does that make sense, guys? Yes?
We earned interest interest on the note?
Yes.
Okay.
Then it says, after closer inspection, Damon realizes the bank incorrectly charged the company's account $300 for an automatic withdrawal that should have been charged to another customer's account. The bank agrees to the error. So, does that affect our company at all? No, it only affects the bank. So we then are going to show that bank error, add the 300, and do you see we balance? Our bank balance per reconciliation of $13,567 equals our company balance per reconciliation of the $13,567.
Can you leave it up for a second?
Of course.
What was the bank error? I just forgot to.
Minus $300.
From our side?
No, the bank took money out of our account when it should have been another customer.
So for this on their side, for the fixed employee.
No, we're showing it. Bank balance, we're adding back $300. They took it and they were wrong. But we don't do anything on our side because we didn't do anything wrong. Okay?
It's a positive because that even back.
Correct. Totally correct.
What if they're like, no, just hypothetically, to make things more difficult, they charge us and we get a fee for it, then we credit the fee to make it go away?
If they charged us a fee that was wrong,
Right.
and it was wrong, we wouldn't show it on our books. We would notify the bank and they would pay that money back to us. Okay? How are we doing so far? Is it making sense? Isn't this easier?
Yes.
This is easier.
So then the next step is we are required to prepare journal entries that record those items that were affected our company's balance. So because we received that note and interest, we're going to debit our cash for $5,320. We're going to credit notes receivable because we did have a note out there on our books, but now that we have it, we're going to get rid of it, which means we credit it to reduce it. We now have interest revenue of $320. So we increase our cash of $5,320. We credit our notes receivable of $5,000 and our interest revenue of $320. Okay, guys? No. It won't always be positive. What if the bank put a deposit into my account that wasn't mine? Then we would subtract it. But you know what? I've never had that happen.
No, that doesn't usually happen.
I only get the opposite.
Yeah.
Then the other item that we need to record a journal entry for, service fee expense, a debit of $150, and we credit cash of $150. Remember, we only provide journal entries for those items that we have not yet recorded in our general ledger. Does that make sense, guys? Now, we're going to start next time talking about petty cash and employee purchases. So what I would love to see you do is go through some of these exercises regarding bank reconciliation and make sure you have that mastered.